Hey guys, I'm Shelby with Shelby Paget Realty,
I'm Robin with Shelby Paget Realty.
and today we are sitting down with David Moberly. Tell us a little bit about who you are, what you do, how long you've been in the business, and then we'll have some really cool, interesting questions that we'll kind of go over in depth, so that our audience can be most informed.
Awesome, thanks for having me. My name is David Moberly. I am a mortgage loan originator with Academy Mortgage. I've been in the industry now for about 11 years.
Nice.
Second time at Academy, I was with Academy, left, I'm back at Academy now. So what I do is I help people put the financing together for home purchases.
Very cool. And we kind of have a special connection with you because you actually helped my wife originally, and then also Robin and Tony with their home loans. So your name had come up over the years like many times that you got to reach out to David, and I know we kind of crossed paths here and there, and then we were finally able to connect. So it's been pretty cool getting to know you.
I think if I did more dirt biking, I could connect. My wife would love that. Just big dirt right in the back.
Well, thank you so much for making time, and we kind of want to just touch on a few topics that I think, and you may think that don't get talked about in enough detail for buyer clients and the folks that you work with and that we work with regularly. And so I'm going to ask you a few questions, and we just kind of dive into them and see what your thoughts, your perspective are, and your opinions, and how it may be helpful for those that are watching and learning about what it means to start getting into the market, whether they're buying first-time home buyers or VA loans, or people looking to get into investing, or if they're transitioning while the market's high from their current property position to whatever they may be going into. So one of the first questions we want to talk about, and probably one of the most relevant in our height of this market that we've seen, is appraisals. So give us a little bit of an overview of what the appraisal is for those that may not know it in full detail, and what the importance of understanding that concept and that process is through contract.
Sure. So an appraisal is essentially a third-party verification of the quality and the value of the home that the lender is collateralizing. So in other words, if I loan you $500,000 on a home, we want to know that if we ever had to pursue foreclosure proceedings or whatever, the home is worth that.
Okay.
So the way the appraisal works is we have an independent third-party appraiser goes out there. They are going to obviously inspect the home, primarily going to look at comparable sales around that. So in a market like ours that's seen a lot of growth, our big challenge is we may have an asking price that's absolutely at market, but we don't have close comparable sales that justify that value if nothing's been sold around that.
A little bigger gap between assessed appraised value versus what the market push is going for, right?
That's right.
What's some of the gaps that you've been seeing come across the table over the last 6 months or so?
The last 6 months have been a little bit better. Last year was real tough because we saw big growth post-COVID. It seemed like the market kind of died in April and May, and then by November, December, we had seen a massive growth, and there weren't comparable sales to justify that. So I think the largest I saw was 120,000.
Wow.
That was a massive one. That was one that we'd gone into with the agent having prepared the client well. That we're not seeing comparable sales that justify this value, even though we think this is what the market supports.
So we've got ways that we help kind of set expectations in that regard in the conversation with the clients. What are some things that you think are really important steps in that process to help mitigate any surprises or hurdles for the buyers in those situations?
So the main thing I can do, I don't have access to comparable sales, so I have to sort of trust that their estimation of the offer price makes sense. But what we'll do a lot is we'll kind of structure a couple of different loan options. So if someone's wanting to put 20% down, we'll also explore what does 10% down with a single mortgage insurance premium look like in the event that we have to bridge an appraisal gap. One of the things that I think is also really important for lenders is that we have a pretty good relationship with appraisers that understand the market. So rather than using massive appraisal management companies or working with appraisers that are all over the place, we try to have on our pool of appraisers folks that are pretty limited to this market and really understand the value changes and the growth. So I think that's been a huge advantage for us as well.
Kind of helping set expectations
on the front
end.
Yeah, and letting them know that I'll have appraisers tell me, I totally understand you had 6 people making over asking price offers. We don't have comparable sales to support that value. So I'm not saying the home isn't worth this. What I'm saying is comparable sales don't support that value. So kind of helping clarify that with clients to say, you're not getting a bad deal. The issue is we haven't had a home sell in that neighborhood for 2.5 years, and it's a drastically different market than it was 2.5 years ago.
It's definitely true. And that helps too with our perspective and like having someone you partner with, not just an online discount broker lender, to where you and I can have those dialogues to help set the expectations, to really vet out the property values with the clients and the options that they have at hand. we have a lot of scenarios where we'll sit down with the buyers, and it's good to kind of put on the table, okay, like you said, if you're putting 20% down, that's your expectation. Sometimes people have like this gravity towards 20% down is like the rule, but there's a lot of variance, and if the appraisal gap is 15-20K and they have 20% to put down, there's a way to be able to orchestrate that deal to make it happen and still make sense for the buyer clients so that they get the property they want. So.
Well, I always say ultimately you're still borrowing the same amount of money. It's just we're using a value that's a little different, so the loan to value looks different, but something like a single mortgage insurance premium that's financed on the loan can have the ability basically to get almost the exact same monthly payment as you would have had the home come in at value.
Cool.
So that's one. The other strategy we employ a lot is both Fannie Mae and Freddie Mac have value pools for homes, and they've been increasing the available number of appraisal waivers in the last few years. So having clients having that conversation and say, if we get an appraisal waiver, that's a good thing. And often a client will say, well, I want to know the appraised value though, like that gives me the warm fuzzies. But we say the appraisal is one man's opinion of values based on past comparable sales. So if we have the opportunity to go with Freddie Mac or Fannie Mae or vice versa to open up an opportunity for an appraisal waiver, what that does is it allows us to move forward knowing how to structure the loan from the beginning.
That's great. What does the appraisal waiver do?
It essentially, through Fannie or Freddie Mac are the two that offer those, and this is true on conventional loans only. So if you've got a VA, you've got an FHA loan, you're not going to get a waiver. Most investment properties, you're not going to get a waiver. Most cash out refinances, you're not going to get a waiver. But on a conventional purchase, conventional refinance, Fannie and Freddie Mac both have databases for values. So I can plug in a value, and if we run it through automated underwriting and it comes back and says no appraisals needed, that allows us to completely skip the appraisal process. No desktop drive-by, saves the client money, and saves the deal falling apart for a weird appraised value.
We've seen that come in on a few of the clients who are purchasing, and you say it could be on any conventional, so could that be a 5% down and up, or does it have to be a minimum?
So minimum 10% down for Fannie, but I'll tell you don't get those very often. Minimum 20% for Freddie Mac.
Okay.
And so 20% is really where you start to see those waivers a lot more.
That makes sense.
Often.
Perfect.
Sure.
Yeah, one of the things too, just kind of a random aside that we've helped clients understand that, if it's a numbers perspective, if they end up having to pay PMI because they had to make up a difference for appraisal gap, there's a return on investment on those things. You can see if it's 3, 4, 5 years, if the market continues to accelerate or gain in value, you can always get those PMI,
that's right.
The mortgage insurance knocked off if you get a broker price opinion, something along those lines. We've actually done that on a couple of our personal properties over the years, and it's a great way to just save that extra money and not have to end up paying that mortgage insurance indefinitely.
That's right. Yeah, 2 years is generally, that Fannie Mae's recommendation to servicers is 2 years. So when you do the math for a high credit borrower, a lot of times that mortgage insurance can be, it's under $100 a month, or we can do a single mortgage insurance premium financed. So maybe they're borrowing an extra $3,000 or $4,000, but with almost no impact to the payment.
Now, sometimes there's options to do, I've heard of it, and maybe you can elaborate on a little bit, but for mortgage insurance, a lot of people have kind of a hesitation with paying PMI just because of just principle of it.
Right.
But if you break down the numbers, like I said, it can add up and be just fine. Is there an option to pay the PMI up front and put that onto the loan on the back end? Can you explain what that means?
Absolutely. So we work with 6 different private mortgage insurance companies, and all of them offer mortgage insurance in one of 3 ways. Okay. Purely paying it monthly, a single premium up front that can be financed if they've done more than 5% down, or a split. So often it's a 1% financed up front or 1% out of pocket up front with a lower monthly. So I don't do that one very often, because usually what we're looking at is how long we're going to be in the home before mortgage insurance goes away. And most single mortgage insurance premiums have a repayment period of right around 3 to 4 years.
Yeah.
So if we look at a home that we say, we don't know if value is going to increase that much in the next 3 or 4 years, we would maybe do a single premium. Gotcha. I rarely do single premiums anymore just because of the growth in this market, though almost always at the 2-year mark we're ready for that broker's opinion of value and get that mortgage insurance removed.
Yeah, so if it's a $5K premium up front, divide that by 36 months, and you get your breakdown per month to see if it's more or less, right?
That's right.
Okay, cool. That's helpful.
Yeah, and I always say my job's not to tell you what you should do. My job's to give you options so you can know what you can do.
I love that perspective. And buyers appreciate that.
For sure.
So, moving on to some of the other options, a lot of people we work with, obviously totally different buyer situations. You got FHA, you've got VA loans, you've got conventional investors. What are some of the programs that you've seen where there's maybe not as much insight or clarity as maybe there could be, and how would you kind of suggest that you guys have options that may suit those buyers, like especially the first-time home buyers. That's a huge portion right now that's really struggling in our
Right.
market. What are some opinions or options that you guys have that help those folks?
So the big one for first-time homebuyers always jumps out is Idaho Housing and Finance Association. So when folks are working with online lenders, that's one of the first thing we'll ask them. Not necessarily even trying to compete, but just say, do you have the option for a local housing and finance authority? If not, you're probably missing out on some options. So Idaho Housing and Finance has a forgivable grant to help with down payment. They have good credit reward seconds, and what that means is if your credit score is above 640 for some programs and 680 for some programs, we can do a second mortgage for 2.5% up to 3.5% depending on the loan type.
Which can cover the down, right? The
Can cover-
3.5.
Yeah, on an FHA loan, you can do a 3.5% for forgivable grant or 3.5% second loan to cover the entire down payment.
Cool.
So in a market like ours where sellers aren't paying closing costs, we'll exercise those a lot because a borrower has enough for either the down or the closing costs, maybe not both. So sometimes we'll do a small second or a small forgivable grant just to help them make a really strong competitive offer where they're not asking the seller to pay their closing costs.
That's
Very
awesome.
cool.
What are the qualifying factors for that kind of grant?
The easy answer to that is income. They're all income based, so they're geared towards helping folks that wouldn't otherwise be able to get into a home. So they're going to have income limits, and there's like 6 different tiers of income limits depending on the loan program that we look at. There's some tax credit programs that are available where they're getting a discount on their federal tax returns. I should say federal tax income. FHA, conventional, they're all going to treat those a little bit different, but primarily it's income driven.
And for first-time home buyers, what's, if you, off the top of your head, if you remember, what's the lowest come to close you've seen for a property in the last maybe year and a half or so?
In the last year and a
I'll tell you
half,
what ours is. We'll see if we're anywhere near.
yeah, I'm trying to think if we've had a true 0.5% in the last half year. I think we have, if not year and a half, 2 years, but it's the very minimum a borrower can invest is 0.5%.
Yeah.
And we used to hit that a lot. 2-3 years ago when it wasn't so competitive and sellers were paying more closing costs, that was actually very normal to have a buyer bring in 0.5% of the purchase price. That's changed just because of the competitive nature of offers. But 2,000 to 3,000, 4,000, we've still done that some. Stars have to align, right? It's got to be an agent that gets a great offer accepted, and appraisal has to hit just right, and all of those things come to play. But we still see under 5,000 fairly often.
Very cool. Yeah, I think our lowest is around 2,400 or so. So moving on from FHA, what's the current VA environment? What does it look like? What are you suggesting or providing options for people that may have bought a house on a VA loan 2-3 years ago, and what's their situation kind of like right now in the Valley?
So VA, I'll tell you the challenge that we have with VA is sellers don't always have a lot of incentive to take a VA appraisal because often that comes from a client that maybe doesn't have a down payment. That's why they're using the VA loan. Appraisals are generally a little more strict on a VA. So one appraisal difference is on a conventional FHA RD loan, we have an appraiser panel though. We vet them, we make sure that they're great customer service, they treat clients well, they understand the market. On any VA appraisal, that's actually ordered through the Veterans Administration. We have no control. So I just tell people, plan on the full 14 days, and I'm not going to hold my breath for it being the best report I've ever seen. And that's a massive generalization. There's some great VA appraisers. There's some that I would love to see retire out of the industry, but the reality is we don't have control over that. So that's the big issue for buyers using VA loans. So oftentimes we'll create a strategy where we'll have a conventional offer and a VA offer, and we try to show them the merits of both, knowing that potentially going in with a conventional offer, even if it's a low down payment, a 5% offer, that's going to create a higher likelihood potentially of your offer being accepted. Not because sellers are discriminatory or anything like that, but just because those VA loans have enough guidelines that a seller that's presented with cash offers, conventional offers, and VA offers, they're just sort of incentivized towards the loans that have less potential issues.
For sure.
One great thing about VA though is for a veteran with full eligibility, a couple years ago the VA eliminated their maximum loan amount to match the Fannie Mae conforming loan limit. So for a borrower doing a $700,000 loan, if they have their full entitlement, that can still be a true 100% financing option for a veteran.
And how does that look in contrast to how it used to look?
So it used to be that if you exceeded whatever the conforming max loan amount, which this year is $548,250, for every dollar above that, the veteran had to bring in 25% down payment. So it was still a nice low down payment option, but it's a true 100% financing option.
Now they can do the full amount.
Million, 1.1.
So
I mean, we run it through automated underwriting, and so sometimes we don't always get that, but yeah, I mean,
potential
for it.
You mentioned RD. Can you expand just real quickly?
Yeah.
A lot of people don't know what RD
Sure.
loans are and how are they relevant to our valley.
Absolutely. So RD stands for Rural Development. You'll also hear interchange with USDA. And the reason is the United States Department of Agriculture actually underwrites the rural development loans.
Cool.
So USDA is the backer, RD is the loan type. Idaho, what I love about Ada County especially is we still have two great popular areas for RD. Pretty much all of Kuna is going to be eligible for rural development.
Incredible.
I mean, everything south of Columbia. So I go, if you can find a house in Kuna that's not an RD, good job. Almost all of Star. So if you're north of the river, and a lot of people love that Boise River area, once you get to Highway 16 on towards Star and Middleton, that's all eligible RD area north of the river. So we're not talking about living way out in the sticks. These are really prime buying areas. True 100% financing options. Rural development loans, I always just say
Did you
these.
say 200%?
Up to 100%.
Up to 100%.
Sorry, if I did say 2, I apologize. No, 100. No, we're maxed at borrowing the purchase
Well,
price.
that's cool.
That's an amazing loan. No problems here. Yeah, we don't see any issue with foreclosures in the future. No, so RDs are very restrictive, and the challenge with RD loans, people ask, well, what's the income limit? There isn't one. I'm sorry, what's the purchase price limit?
Sure.
There isn't one, but there's a strict income limit and a strict debt to income ratio.
Gotcha.
So it's one of those loans where you have to kind of fit through a narrow window, but when they work, they're just fantastic options for clients. They have really low mortgage insurance. Interest rates are lower. They mirror kind of your VA, FHA rates, and they're true 100% financing. And if the home comes in above value, we can actually even roll in closing costs to the loan amount. So
Amazing.
I've only ever done that, like in 11 years, I've done it like once. It doesn't happen that often, but it's a neat option.
What are, I guess, your guys' strengths in particular, and what are some areas that you guys want to advise the client appropriately and make sure that they're being able to be helped or assisted in the best way possible?
Sure.
So what are the best loans that you guys really know 100% thoroughly?
Yeah, so at Academy Mortgage, we're a direct lender, meaning that we package loans and then we sell them on the secondary market, either to Fannie, Freddie, Ginnie Mae, VA, or to private investors, depending on the loan type. So what that means is we don't loan our own money. We're a non-depository lender. So we don't have savings accounts to loan from. So what that limits us to is if it's a loan that's not sellable, we're probably, we may have a broker option, but it's probably not one that we're going to be real strong at. So one-time close construction loans, we do them. That's a broker option. We have a 2-time construction loan closing that I think we're better at than the one-time close.
Okay.
Anytime you get into a situation where you're using like a portfolio fund.
Yeah.
So someone had a foreclosure a year ago and they're a really qualified borrower, good money down. There are loan institutions in town that have depository assets. Well, they'll say, we'll underwrite that to our own criteria. I don't have that option. I always say, Fannie Mae, Freddie Mac, they're kind of like the kid next door with a Nintendo. You don't always like them, but they're the ones with the Nintendo. So the least expensive way to borrow money in today's market is by selling loans on the secondary loan market.
Gotcha.
That's our bread and butter is Fannie, Freddie guidelines, VA, FHA, rural development. We have broker options, but they're not loans that we do tons of. So I would say oftentimes when I would maybe give a referral out would be where a portfolio loan is going to treat someone in a little bit better situation, and their local banks have some good portfolio options. That's not our strength. I like the 2-time close construction, but a lot of folks have really enjoy the 1-time close. I'll say frankly, 1-time close, there's companies that are better at that than we are.
And can you explain a one-time close?
Yep. So a 1-time close construction loan is essentially you're taking the finished value of the home and you're doing all of the lending in one piece at closing. The real advantage of that is if we're worried about an interest rate hike in the next 6 months, you're locking that rate today.
Yeah.
What I think the disadvantage is that their fees are going to be a little higher. The fees end up shaking about almost the same as a 2-time close by the time you do a 1-time close, because it's essentially it's an initial loan with modification. The other thing I don't love about 1-time closings is that if there's appreciation through the process of the construction loan, that's harder to tap into. Where on a 2-time close, we're doing a true refinance at the end of it and taking the current value of the home.
Okay.
So I think there's pros and cons actually of both models. I think there's some things that 2-time closes are better. I think there's some that 1-time closes are better. What I often tell my clients is the best construction loan is the one that your builder carries though. Yeah. So if they're passing a cost to you for financing, great. It would have cost you money for financing, and then we're allowed at the end of this to do a Fannie Mae, Freddie Mac kind of conforming conventional loan that's going to just, then the builder has draws on their own timeline. They're not waiting for our escrow disbursements 1 time a month, which they just seem to delay closings a little bit. Yeah. A lot more inspection costs, things like that. So I always say the best construction loan is the one the builder carries.
Perfect.
If that's not an option, either I'm going to recommend probably a 2-time close if we're going to do it in-house, or potentially make a referral out to another company.
Very cool. Thank you so much for your time
Thanks
today
for having me.
and all the amazing information. We're going to be posting this. We have a private Facebook group called Buy in Boise.
Wow.
So investors, buyers, clients, people of the industry and whatnot, wanting to learn and explore and share their experience in real estate or entrepreneurship or financing. We're going to share information like this so we can best equip the people that are part of the group. But yeah, we'll be on YouTube,
Awesome.
TikTok, Instagram, pretty much anywhere. Social media is where we'll be. So
Sweet.
thanks for watching, you guys. If you have a chance, go ahead and click that like button. Helps us a ton. Subscribe to our channel because we're going to be releasing content on a regular basis to help answer questions you guys have. If you have any questions, definitely leave a comment below so that we know what to answer as we produce content on a regular basis. Thanks for watching, guys. We'll talk to you soon.